Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V Group, our digital marketing partner. Robb, how was your week?
Week was great. Weekend was good. Ready to hit the ground running on this Monday and exciting another issue of the five things that we're happy to bring to everybody. Gary, how was your weekend?
It was all right. A lot of work outside, cut the grass, trim the hedges, was splitting wood. I've decided to I guess I'm in my little house on the prairie phase. But we could be calling this week the excessive pollen issue. It is very pollenish here in Connecticut in the spring, and so spend enough time outside, and it's unpleasant.
I recently learned about the pollen issues that I did not know about 6 months ago. I would say one of our clients is actually a car wash, multiple different car washes out in the Connecticut or they're in Pennsylvania, New Jersey area, and they told me about pollen. So that's what I know about pollen and that it's no good for the cars.
Yeah, it's not. And my pool cover and my outdoor furniture, like
Not good for them either.
the pollen is so thick you can actually like see depth to it.
Wow. Okay.
Yeah, it's a lot. The trees are very promiscuous this time of year.
All right. Well, with that being said, your once in a lifetime education on pollen and car washes. So
Yeah,
let's get
we
into
cover a
it.
lot here.
We do. We always do. Try and have a good time at least. So the economic doomsday issue we're talking about this week. Lots of interesting stuff we're talking about. Numbers not matching up with what average Americans are seeing in terms of their struggle. We're talking Atlanta Fed going back to the GDP. We had an awesome webinar here at DKI the other week with authID, portfolio company. Going to be talking about that, Gary, and more there. Job openings, manufacturing, the whole nine yards. Should we jump right into it?
Let's go.
All righty. Thing number one, Gary, the Kobeissi. Am I saying that correctly? I should have asked you prior to this.
You know what? I follow them on Twitter, or sorry, now X. It's the Kobayashi Letter, but I don't actually talk to I don't know how
Yeah.
anyone pronounces anything on there because I read it all. I just know what it looks like.
Well, not to derail thing number one, but the Kobayashi Letter, their X handle is at Kobayashi Letter. You'll have to look that up or find our written version of the five things on the bifurcation of the economy.
So these guys, I think they do a really nice job of explaining macroeconomics on X, and they were kind enough to give us permission to use their post for this week. It got about 750,000 views, which is amazing. And they pointed out, and this is in one post, that the U.S. economy now has 63 banks on the verge of default, according to the FDIC. Over $500 million of paper losses held by banks. Just a reminder, these guys did not manage their duration risk in their bond portfolios well. That's why we saw banks going under a year ago. Their point three here, declining GDP growth with rising inflation, heading for stagflation. Over 50% of Americans believe we're in a recession. We'll come back to that. Lowest mortgage demand in over 30 years, a record $17.7 trillion in household debt. I'll also point out that doesn't include buy now, pay later. So the real numbers could be worse. And they conclude with, how in the world is this a soft landing? They point out the disconnect between economic data and consumer sentiment is huge. Most of the data suggests things are fine while consumers are struggling. This is something DKI has been talking about for months. And they conclude here that this is far from an indication of a healthy economy. I agree with them.
Gary, on the other side of the point, right, you have those groups that are pointing to low unemployment, growing GDP numbers, declining inflation. I know we've had some conversations about the sides of the aisle here. What's your rebuttal to those individuals?
Yeah, so this isn't so much a political point, but I have been having, these debates with people in the FinTwit or the FinX community. And these are smart people. They've earned their point of view. They've done a lot of research. And what they're looking at is they're looking at aggregate data that looks pretty good, right? We have GDP growth, we have rising wages, we have low unemployment, lots of job growth. Inflation is lower now than it was 2 years ago, and they're saying, hey, things are terrific. And if you look at the aggregate data, they're correct. And the Kobayashi letter concludes here that the disconnect between economic data and consumer sentiment is simply huge. Most of the data suggests things are fine while consumers are struggling. I'm with them on this. This is what I'm seeing as well. So, it's really easy to say, well, we've got low unemployment. Yeah, but those unemployment numbers are faked, and we're double counting people who, instead of having one full-time job, have two or three part-time jobs. So we're counting them in the numbers 2 and 3 times. We've had no growth in native-born employment in something like half a decade. We don't have more people working. We have the same people working more in order to make ends meet. Growing GDP, technically, yes, but that is 100% of that is debt-fueled government spending. That is not sustainable, and that's not a healthy economy. The private market economy is floundering. We'll come back to that later in this version of the 5 things. And inflation, while it is down from a couple of years ago, it's still high. I believe it's criminally understated and intentionally understated. So, this is a situation where, I've been debating hey, the economy's fine people, because they're looking at aggregate data. We're looking at discrete data. And, Kobayashi, I thought they came out with a post on this, really outlining a whole bunch of points that illustrate the issue that we have. And I agree with them. I think we're in a bifurcated economy with a small number of people doing very well. They're pulling up the averages, and a large number of people who are very worried, and understandably so. And I don't think those people are wrong to be worried.
Check out Kobeissi Letter on X, and thank you to them as well for allowing us to use that piece to contribute to this week's 5 things.
Yeah,
Moving to
they
thing.
were just so they were very gracious about it.
Great.
So yeah, I want to thank those guys as well.
Great. Moving on to thing number 2, Gary, the Atlanta Fed lowers GDP forecast by a lot.
I cannot wait till Andrew throws up the graph on this one, because if you find financial graphs funny, if you find them entertaining, this graph is about as funny as it gets. So the Atlanta Fed, they have this metric they use. It's called GDP Now, where they estimate where they think GDP is going to be. And they took their estimate from a little over 4%, I think around 4.1, 4.2%. And all of a sudden, a month later, they lowered it to 1.8%. Right? That's a 60% cut in their expectations for GDP growth. What in the world happened here? And then, the whole thing gets even funnier, because it's not in the graph we have here. But as I was writing this, the Atlanta Fed then revised their projections again. And now they're saying something more than 3%. So they went from like 4.1% to 1.8. Now they're above 3. One might conclude that they're just randomly pulling numbers out of the air. The graph looks like a little kid scribbling. So, yeah, I don't think anyone there knows what they're doing.
With their initial expected GDP growth in excess of 4%, I think the question, what data might they be looking at? How do they even get to that particular number? And then, I mean, what would even need to happen in terms of that actually coming to fruition?
So I don't know. I don't know what data they're looking at, but what I do know is, the economy here in the United States is almost $30 trillion a year. Um, there's an old expression about, trying to turn around an ocean liner, right? It's not a speedboat. To change the direction of an economy as large as the US economy takes time. It doesn't happen quickly. And so, to go from 4% growth to 1.8% growth, like, I have no idea what data they're looking at that would cause them to change that much. But 2% of 28 trillion is itself a really big number. One of the things we pointed out, and intern Andrew Brown did a great job in pulling together these graphs. We had them up from our monthly letter a couple of months ago. But what we did was we figured out that the Federal Reserve is unable to predict the Fed funds rate 12 months out, even though they control it. And they have more data on the economy than anybody else. So the people who have the most data and control of a number literally can't predict where the number is going to be in a year. The Atlanta Fed is not able to predict, GDP. Their GDP Now estimate. The only conclusion I can come to is the government is terrible at projecting anything and the private market economy is struggling. The reason that I believe we're not going to hit an official recession is because of governmental spending. Again, I make this point every week, but nobody in government, either party, this is not I'm not blaming one party for it. Neither party, nobody wants to run for reelection with the economy in a recession. And so they're going to basically fund higher and higher deficits with inflation. We should expect more inflation coming, but nominally high GDP numbers. And the issue with that is we're going to have a GDP number showing growth because of government spending, which is not investment, it's all consumption being pulled forward. And a weaker private market economy. And they're going to say, hey, look, but we have GDP growth. So basically, Congress can make the Atlanta Fed right about whatever number they want. It just depends how much they're willing to spend.
Thing number three, Gary, moving forward to authID, who we've talked about a little bit in the past. We were fortunate enough at DKI to host authID's management team. Ticker is AUID, and that's our thing number three. Tell us more about that, Gary.
That was kind of a cool thing for us, to be an
Yeah,
independent research firm.
very
And,
cool.
we had a CEO, Rhonda Guro, CFO, Ed Solito, Chief Technology Officer, Tom Soki, and new board member who's a partner at Bain, Kunal Mehta. And they all joined us for this webinar, which we live streamed to X and to LinkedIn. And we did put the video up here on YouTube as well, and it's on the DKI blog. So, that was quite a thing to have. And it's pretty exciting for, an independent research firm to get the whole management team of a company. Ron DeGuro, the CEO, spoke a lot about the rising worry that people have regarding deep fakes. And he showcased in this great example how authID's technology identifies and rejects these kinds of, they're called insertion attacks.
Hmm.
And the really interesting thing about it is people are very focused on how good the deep fakes are getting. And
Right.
they're you really can't tell when from voice, and the video is getting to the point where it's getting difficult for somebody who's not, really schooled in this to figure it out. But what authID does is they look at the source and they say, hey, wait a minute, this is an insertion attack. You're not using, like the camera of the cell phone. You're not using the image isn't coming in the right way, or the video isn't coming in the right way. And they're really good at figuring that out. There is a huge amount of demand for this. Companies are getting hacked every week. And one of the things that they talked about is the regulatory environment. Like when you talk about, hey, why now? Why is this going to grow? And because companies have a regulatory requirement to do something to protect their accounts, to protect their back end, to protect their data, their customers, their customer accounts. And if the answer is, well, we did something and it got hacked, you can actually live with that answer. And in certain situations, depending on how it works, you may not be legally culpable. But if you do nothing and you get hacked,
Mhm.
that right there is willful negligence.
Right.
You know,
Gary,
gross
are-
negligence. Sorry, gross negligence, willful misconduct. That's the standard. So that's it's a bit of a problem.
what, Gary, just from your perspective personally, I mean, what was the big takeaway for you? Obviously, you've recommended or you've reviewed, put out authID. You've invested in the business. I mean, what was your key takeaway? What did you like the most? What's your biggest bullish case, or just whatever that takeaway might have been?
Yeah, let's
Top of the list for you.
let's talk about that for and we should give people a little disclosure here. I do own authID in my personal account, so if that makes you guys think I'm biased, you're entitled to that point of view. I will also point out neither I nor Deep Knowledge Investing was paid by anyone in any way. We were not paid by authID or anybody else. We hosted that webinar because we wanted people to see Rhonda grow in person, and Ed and Tom and Kunal. I think they're personable people who present really well. I like that they're not defensive, that they're really straightforward. They never duck difficult questions. I just find them to be really honest and straightforward. I wanted people to see that. So I own the stock, but we were not paid to do this. I think there are three takeaways that are are worth talking about. One is Ron DeGuro, the CEO, expressed confidence in the company's sales and bookings targets, and his guidance for bookings for next year were well above what I have in my model. And I've said in my report, which is available on the DKI website, if you click the research tab, the full report is available. It's not paywalled. You're welcome to read it. But I say in there that if things work out, I could see the stock going up, 10x to 15x from its current price, over the next 5 to 6 years. And that's based on the model that I have. And what Ron is saying is that my numbers for next year are very, very conservative. So you can look at that and say, either my price target is too low or they'll get to, my price target sooner. Again, they still need to execute on this, but this was the CEO talking about what he sees in the pipeline. The second point I'd make is CFO Ed Solito talked about the fact that the company needs to raise money later this year. They need to do a secondary financing, and he expressed confidence in the company's ability to meet financing needs later this year. I think it's an important milestone for the company. We should expect to see that in the next 3-4 months. Based on my understanding and speaking with a lot of the shareholders of the company, I agree with Ed. I think the company is going to be able to get the financing they need, and that it should be enough to get them to self-financing. They may need to do another financing next year, but by the end of next year, we're talking about less than 18 months from now, the company should be self-financing. And so that I think is a big step. And then it's worth, if people have the patience and the interest, check out the video and check out Kunal, who, he's a partner at Bain, and he talked about potential strategic partners for the company and a strategic vision and the sales outlook. And, this is a guy who he's a big picture guy and has been around the venture capital and technology world for decades. And I thought he was really impressive talking about that stuff as well.
Great stuff, Gary. Yeah, thanks. I know you did a lot of work coordinating that and putting that together, and obviously the authID team as well for being a part of that. I was on there, and yeah, it was a great webinar. Lots of good insights. So keep everybody in tune with developments with authID here moving forward. Thing number 4, we're moving to jobs. Job openings down again in April, Gary.
We are back at the good news is bad news is good news part of the show. Basically what that means is that every time we get bad data for jobs, the market goes up. And the reason is they think that means the Federal Reserve will lower interest rates and blow up another asset bubble. Every time we get good news on jobs, the market craters because they realize that means higher for longer. The thing that I find funny about all of this is the jobs numbers are faked. They're not real. They're constantly made up and revised. And we've seen all kinds of situations where, the data that's reported, they'll beat estimates by 100,000 jobs in a month. And everyone says, wow, this is terrific. It's a huge beat. But if you look at the prior months, they'll have adjusted the prior months down by, 115,000. And so the net jobs that everybody's focused on the headline number, which is great. But if you look, the net jobs actually are down. In this case, the news that was bad for the economy, but good for the doves, the people who want the Fed to lower rates, was the job openings are now down to 8 million. Now, on an absolute basis, that 8 million number is actually a really good number. And it's more than the number of people looking for jobs. There's still more than one job for every one person looking for work. But, people correctly pointed out that early 2022, job openings were a little over 12 million. And now they're down to 8 million. And people are saying, hey, wait, that's actually a pretty big decline. And they're correct. Now, later in the week, we got an employment report that showed an enormous 272,000 increase in jobs. And that got people really worried. The market was down because they figured that meant higher for longer. But, I'm just going to point out that as usual, 100% of that was part-time work. Most of it is in government and healthcare. And it's not that I'm against healthcare work. I'm just going to point out that that's largely funded by government. And then we have the weird situation where full-time employment continues to fall and the unemployment rate ticked up to 4%. So, think about it for a minute. We've got, I think the market was looking for 180,000 jobs. Instead of 180, we got 272,000 jobs with a decline in full-time employment and an unemployment rate going up over 4%. These are not people getting good full-time jobs. These are the same people working more jobs to make ends meet. And this is where we go back to, the Kobeissi letter, where they're saying, hey, wait a minute, the average number is good, but we've got problems all over the place.
As always, you had both sides of the coin. Some people looking at, hey, reduction in job openings leading to lower interest rates, and then vice versa. Is the craziest part the fact that the data that they're making these claims off of is inaccurate? And then follow up on that is, should I even ask whether or not we are going to see a rate increase one way or the other
You
before
should
the election?
you should always ask that question. Why would anyone go a week without contemplating what the Federal Reserve is going to do?
Yeah,
As you
that's
know,
right.
it's the only thing that matters, right?
That's right.
We could change the show to what's the Fed going to do and just do that every week, and it's
Or did the Fed raise rates? Yes or no, and that's the entire show and call it a
yeah.
day.
You know what? We could run our economic policy with a magic 8 ball.
Yeah, there you go.
That's just so we're clear on this, and so YouTube doesn't get angry at us. We are talking about the children's toy, not any kind of drug paraphernalia. Uh, anyway, back to the adult part of the show. Um, yeah, the thing that's really weird about it, Rob, is the market trades with a lot of volatility around these numbers. People react to them, and billions of dollars of market cap is created and destroyed based on this. And the thing that's weird about it is the numbers aren't real. I mean, a couple of months ago, we saw the Philadelphia Fed somehow miscounted 800,000 jobs. Right. So we have a month where everyone's saying, wait a minute, this 272,000 job increase, it beat expectations by 90,000 jobs. But we have another month where, 800,000 jobs just disappear because they're being miscounted. It basically, I'm pretty sure in the back room, there's a squirrel that just makes up random numbers. The market trades off of that and then they adjust it later. Beyond that, last Thursday, I was fortunate enough to get an invite from Michael Guyette of the Lead Lag Report and the ETF think tank. And those guys they hosted me for their weekly Get Think Tanked podcast. And, they, of course, asked about what I thought the Fed was going to do. And, during this program, I reiterated my belief. I don't think the Fed's going to change the Fed funds rate before the election. They're definitely not going to do it later this month. I think if you get out to like September or November, doing this right around an election is going to lead to charges of political meddling that the Fed, whether the Fed has a political bias or not, they prefer to maintain the appearance that they don't. And so, basically, if the Fed changes the Fed funds rate, I wouldn't expect it to happen before December. If it happens, if I'm wrong about this, it's because the economy has taken such a horrible nosedive that not even excess trillions of dollars of congressional overspending is enough to mask it. And if that's the case, the economy's in free fall. And if the Fed does something in an emergency, I don't know that that's going to be good for stock prices. So, for the people who are thinking the Fed's about to lower rates, I would not count on it.
Great stuff. Great analysis there, Gary. Thing number 5, talking manufacturing again. We have a decline for a second straight month, Gary. Thing number 5.
Yeah, so we're looking at the PMI, that stands for the Purchasing Manager Index. And what that does is it measures the level of manufacturing activity in the economy. And it fell for the second straight month from 49.2 to 48.7, down 0.5%. Now, is that a big number? No, it's not. But, when Andrew throws up the chart here, what you'll see is that both the long-term and short-term trend are down. And it really leads me to the conclusion that I keep drawing, that what's holding the economy up, or rather the accounting of the economy, the GDP number up, is congressional overspending. It's not the private economy. When we see numbers like this, it looks like manufacturers and companies are seeing less demand. They're preparing for less demand. They're sort of setting in for a possible recession. And I think we're not going to have the official recession because of government spending, but companies are pulling back, and this is the second straight month we've seen declining numbers.
One factor that we see that contributes to the cooling sentiment, Gary, is reduction in lead times. easing of supply shortages. What do those things generally tell us?
So during the pandemic, everybody talked about difficult supply chains. It was difficult to source product from other countries. And that's why people talked about, instead of having a just in time, very fragile, but financially efficient supply line, companies started to invest more money in more robust supply lines. And they're saying, you know what, we're going to pay a little bit more so that we have more control over when we receive goods or whether we receive goods. And so what we're seeing now is there's a reduction in lead times and easing of supply shortages. And given that we are years past the COVID related supply issues, what that means is that companies are just saying, "Yeah, we're not using all of our capacity." If you call them and you say, "Can you make something for me?" They're saying, "Yeah, we have capacity. We can do this. We can do this quickly." Shorter lead times suggest lower demand for goods. And look at what we've seen, Rob, over the last few weeks. A couple of weeks ago, we talked about decreased consumer purchases at Target. Best Buy had a weak sales outlook. And most recently, last week, at the end of the week, GameStop had a 29% reduction in revenue. And, sorry to the apes out there, I'm not against you guys, right? Like I've never been short GameStop. I'm not against you. You guys want to get on the roaring kitty train, go for it and enjoy yourselves. Have fun at the casino. But from a fundamental point of view, this is not like a 29% decrease in revenue is pretty huge. And I actually, because so many people were interested in it, I took a look. I looked at the history here, and this is a company that over the last, I have to bring up a model, but like 5 years or so, revenue's gone from like 8 and change down to 4 and change, and is continuing to decline. So, I think from a fundamental point of view, the people who have been short the company, they've been right on the fundamentals. But the GameStop apes, they've been right in saying, yeah, but you're manipulating markets doing it, and they've been able to exploit that. So anyway, long way of saying, I don't have an opinion on this. Again, I'm not against the apes. But when you have retail companies, every week that are announcing sales declines, sales shortfalls, taking projections down, that's how you end up with a reduction in lead times and the easing of supply shortages. People are just starting to buy less stuff as their credit usage goes up. And that's something we've talked about a lot as well. Basically, we're going to end where we started, which is I think we have a bifurcated economy. I think Kobeissi Letter is right. And we have a small number of people doing really well that are pulling up the averages, and a lot of people who are struggling right now.
Great stuff, Gary. If I had to push you, what is give me a take or some sort of position on GameStop, Roaring Kitty, what's going on, maybe even just for some of the listeners.
Well, I pulled one of the videos he did. I think it was in 2020. And so, there are a lot of people who are saying Roaring Kitty is, he's just a stock promoter. But that's actually not true. If you go back 4 or 5 years, he was putting up videos talking about the fundamentals at GameStop. And he had a vision for how the company was going to handle the shift to online distribution, which now is really, the thing. Um, and how they were going to make their stores kind of this community hub for people who were gamers, whether you like playing video games or I think part of his vision was people would come and play board games like like Dungeons and Dragons. And it was interesting analysis, talking about how the business was going to be transformed. The unfortunate thing is that analysis wasn't correct. That transition didn't happen. Sales declined by a lot. They've continued to decline. They've been declining pretty steadily for years. And so GameStop, from a fundamental point of view, doesn't have um, the fundamental case isn't there. And Roaring Kitty wasn't right on that. I think the area where they have been right is that there has been some market manipulation in the way people have shorted the stock, and they were able to engineer a short squeeze against that. and correctly pointing out that there were people manipulating markets and they had a counter strategy to that. So from a trading point of view, they've been really effective. From a fundamental point of view, I think they've been incorrect. The other thing that I think is really interesting is there's all this talk that Roaring Kitty is going to be investigated for market manipulation. And, my response to that is for what? Right? I mean, the guy established a huge position. He put a meme up on X of him leaning forward in a chair. He's put out a whole bunch of memes. He's shown people what he owns. He's shown his brokerage account. He's got an E-Trade account. And I think earlier this week he had something like a quarter of a billion or $500 million of value there. And, there was talk that if the stock got to like 67 or 69, he was going to be worth $1 billion. None of that is illegal, right? Like, listen, does the guy move markets? 100%. He absolutely does. But it's not illegal to post memes. It's not illegal to post a drawing of you leaning forward in your chair. It's not illegal to show people that you own a stock. It's not illegal to have a YouTube live stream where you talk to people about your outlook. He's been careful to avoid issuing any kind of price projections or saying to people, everyone hold, we're going to get to 400. He hasn't said stuff like that. So I think he's taking a lot of heat from people who are upset, and I understand why people are upset. But from what I can tell, and I am not a securities attorney, I don't see any area where he's actually broken the law. I don't think he's as guilty of market manipulation as everybody who does what I do for a living. Like, we have idea dinners. Hedge fund managers, we get together, we have idea dinners. Or, we'll post, Joel Greenblatt has the Value Investors Club. There's Harvest, Seeking Alpha, Some Zero, that is members only or paid only access to ideas. I post ideas on there. I read other people's ideas on there. How is this any different? Right? If I get to come on to YouTube or X and write and tell people I own authID, here's why I own it, why is it wrong for him to tell people that he owns it? And I do it through more traditional channels, right? So I posted it on Some Zero, right, where other hedge fund managers can see that. So he posted it on X, reposted it on a Reddit message board. He's a better marketer than most of us are. Congratulations for that. But I can't see anywhere where he's done anything illegal or inappropriate. Morgan Stanley's talking about suspending his E-Trade account. They have the right to do it, but my response to that is for what? Right? What did the guy do? He's driven huge amounts of trading volume. And I understand, Morgan Stanley probably does a lot of business with Citadel, and Citadel, they've had their issues. They've lost billions of dollars being short, or where they had a fund where they had huge investments that lost billions of dollars. Being short this, but I don't really know what he's done that would cause him to lose access to his trading account, to his brokerage account. Obviously the SEC, they'll investigate what they want, but for what? I just can't find anywhere where he's done anything wrong or illegal or inappropriate. Again, I understand why people don't like what he's doing, but if I can talk about authID and the people at, Hindenburg or Citron can come out and talk about the stocks they're short, I know Ben Axler and Lex Ganapathy, they're great short sellers. They come out with their ideas in public. Why can't Roaring Kitty tell people that he owns GameStop, and then, you make your own decision? But if you are going to buy it, I would take a look at the revenue trend there and make sure you're good on a fundamental basis, because that's the area where I think Roaring Kitty and the apes have been wrong. I think the fundamentals there have not really gotten better. Granted, they've gone from severely negative free cash flow to sort of flat free cash flow, but flat free cash flow with however many stores they have and leases and fixed expenses and declining revenue ends up in negative free cash flow again at some point. So the company really needs to turn around that revenue trend, unless somebody's got an idea for how they're going to do it. I'm watching this one from the sidelines. There's no way in the world I'd be dumb enough to short this thing, against Roaring Kitty and the army of Reddit apes who will follow him. I'm not taking that risk on, but I also don't want to own something where the fundamentals for years and years have been this negative. So I disclosed my position in authID in GameStop. I'm just, enjoying it as a spectator. And, whether you're playing this on the long side or the short side, what's the expression, Rob? Power to the player. Good luck to
Yeah,
you. Let me know if you're making money or
we'll be
losing money in
we'll
this.
be
I'm
watching.
curious to see. Yeah. Yeah. Let us know how you're doing in it. I'm going to be watching.
Very good. Interesting stuff. Thanks for breaking that down, Gary. And that concludes again this episode of the 5 things with Deep Knowledge Investing. As always, please be sure to check out Deep Knowledge's work as well as Gary's work at deepknowledgeinvesting.com. We have an option for a free subscription, but would also love consideration for a paid premium subscription. Gives you access to all current recommendations, priority delivery of information, exclusive membership with webinar invites, etc. Gary, any final closing thoughts from you?
Yeah, thanks, Rob. So everyone, the channel's grown quite a bit lately. We've had a lot of growth, at least on a percentage basis. I really appreciate it. A lot of that is due to Rob. Rob, thanks so much for hosting, and he was the one who came up with the idea for the 5 things. A lot of credit too to our young intern, Andrew, who's done a phenomenal job on a lot of these videos, and he's gotten us a lot more exposure, and he's done a great job. But for everyone who's decided to subscribe and watch, thank you so much. We really appreciate it. We know your time is valuable, and thanks so much for spending it with us. And we'll look forward to seeing you next week. As of now, I have no idea what's going to happen for the rest of the week. So there's no preview. We'll have what we have.
Exciting week, hopefully. Thanks so much, Gary.